certain days, the news flow on technology in China and doing business with China labors on these markets, i.e. the news flow on Apple and their sales, Tesla and their sales and production. That is what's dragging these markets lower, not the mini pop that you had in news yesterday. We're rolling over to the cash open. We're lower, but still holding above the important 5,100 level. NASDAQ is down, and the broader equity market now in the Russell down by 0.6% as the market grapples with higher for longer. We've changed up the complexion. Bitcoin 67,649. The actual market capitalization of this cryptocurrency has hit 1.35 trillion. So we are looking at a momentum here in the crypto narrative and the risk-on narrative. Yields are coming down this morning. This is a post-Bostic retracement as Raphael Bostic floated the idea of one and done in the third quarter in terms of rate cuts. The market is coming back again, down by 6 basis points. And gold actually makes an all-time record high. That is just worth noting. It's rallied by $100 in the past 5 sessions. One stock to watch at the open, it is Target. The retailer topping its fourth quarter estimates thanks to improving inventories. Abigail Doolittle is with me. Abby, take it away with Target.
Well, the stock is reacting so well. I would say that investors have that old Target feeling this morning. The stock is having its best day since November of last year, up more than 10%, having a lot to do with those improved inventories. That meant that gross margins were nearly 300 bips or 3% better than what was expected, or excuse me, than the estimate. And one analyst saying outperforming even by another percent. That flowed right through to the bottom line. They put up nearly $3 in adjusted earnings. That was 27% better. Sales roughly in line. So again, speaking to that inventory improvement, having less to do, having to worry less about marking down. They also were able to take care of shrink to some degree. Relative to what's been going on, so of course there was a low bar coming into this quarter, expectations of same-store sales down 4.5%. They beat that just slightly, down 4.4%, but we'll take it given the fact that over the last year, the shares of Target really underperforming to the peers. At this point, now flat, but into today over the last year down relative to Walmart up about 28% and the consumer discretionary space up about that much too. Now you have to wonder if they can continue this outperformance for margins and inventories. Manus, will Target have that big catch-up trade?
Okay, well, they're certainly flying high this morning. Abby, thank you very much. Let's turn our attention back to tech. We'll talk about it this morning. iPhone sales in China are falling 24% in the first 6 weeks of the year. And that drags the Apple stock lower again. Ed, it's a 1-2 punch for Apple this week between fines in the European Union and the pressure in China. Where is that pressure in China coming from?
Domestic handset makers and also an economy that seems to be showing more signs of pressure than perhaps we realize. This is data from Counterpoint Research, and it looks at the first 6 weeks of the year relative to the same period a year ago. So Apple's iPhone sales in China fell 24% in the first 6 weeks of the year relative to that same 6-week period in 2023. And what's interesting about it is that on the domestic handset pressure side, Huawei saw its sales grow 64% in that same 6-week period relative to a year ago. And so what you're seeing is shifting dynamics in market share. Apple now holds less than 16% of market share in the smartphone market in China, whereas Huawei, given the growth they saw at the start of the year, now has more than 16% of market share. And the reason I also bring up the strength of the economy is that overall handset sales shrunk, right? You look at all the different names, some grew, the majority saw shrinking sales in the first 6 weeks. The stock's down 2%, we're trading at our lowest level since October. Interestingly, this is one data point, right? It's the most read story on the Bloomberg terminal, most read story on .com. But the other narrative that's out there is just growing disappointment about a lack of an AI story. Tim Cook promised at the AGM February 28th that the AI story is coming. But a part of this, if you look at the comments from the sell side and other strategists, is they look at Samsung, which has talked so publicly about the generative AI capabilities of its latest handset, and they recognize the traction Samsung's getting with that. And they're basically pleading with Apple to say, give us something equivalent that they've not yet done. But yeah, stock down 2%, lowest level since October. And in China, which is, of course, Greater China, around a quarter of revenue, this is a really big problem.
Yeah, and those analysts really are taking against the stock at the moment. Yesterday, it was being removed from Evercore's tactical list, and the list goes on. And thank you very much. Great context around Apple's push lower this morning. Tesla, same story here. We've got extending declines. This as China shipments fall to the lowest level in more than a year. Isabel Lee is with us. Isabel, I suppose the debate will rage here as to what pressure Tesla is under to perhaps move out of Mag 7 to turn into the famous 5. Good morning.
Good morning. That's exactly right. And in China, it's proving to be a tougher narrative for Tesla. So it did sink to its lowest in more than a year, but that's because of a sales lull due to the lunar holiday and, of course, renewed price competition. You know that China is the world's biggest EV market, and shares are now down around 2.5%. Tesla shipped 60,365 vehicles from their China factory in February. That's the lowest since December 2022. That's a 16% drop month on month and 19% year on year. But this isn't really such a big cause of alarm because during holidays, especially the Lunar New Year holiday, which is the biggest holiday in China, millions go off to visit their friends and family. Sales are generally lower. And as we know, China's EV market is slowly slowing, which is why Tesla, in a bid to compete with its rivals, have been offering numerous strategies. This includes discounts on some paint colors and also offering subsidized insurance to really compete in the local market. And this is where things get tricky. We have price cuts by major manufacturers. So this is, again, in a bid to boost sales, prompting some customers to hold back on purchases. And that's according to China's Passenger Car Association. So something to think about there, Manus. It's kind of like a cycle. You wait for a discount, but then you don't buy because you hope that it'll grow, the prices will become lower. So definitely something to think about. For now, shares of Tesla are down 25% year to date, Manus.
Isabel, thank you very much. It's like everybody out there waiting to jump into the property market. It might not do you to extend and wait. So from EVs to semiconductors, US officials are telling AMD that AI chips meant for the Chinese market, they're just too powerful to sell there, at least without a license from the Commerce Department. It's a tough old one to sell, isn't it, Simone, to the Commerce Department?
Yeah, and it's been a tough path to navigate for AMD, as it has been with the likes of NVIDIA, as well as they try and get around that 2022 ban on selling their best AI chips to China. So sources telling Bloomberg, who was first to report this news, that AMD was looking to launch a version of its MI300 flagship chip called the MI309 that would have been compliant with these bans in China. But apparently Commerce Department now thinks that even this chip has too much juice. This mirrors what we've seen with NVIDIA, for example, which went out to the market with what it thought was a compliant chip. Then the Commerce Department said, actually, that's a little bit too exciting for us. They tried to further restrict that, and they've continued to face questions about whether the Commerce Department will allow them. The good news for AMD is that it's never really been quite as exposed to China as its competitor NVIDIA. And Bloomberg Intelligence writing this morning in a quick reaction, this isn't likely to impact near-term sales estimate for AMD or its 3.5 billion AI GPU outlook for 2024 because its main buyers are in North America. That said, this news is weighing on shares today, down 1.6%. But I think you back out the picture, you look gains of nearly 37% so far this year and 151% in the past year, Manus.
Pretty spectacular. Simone, thank you very much on the stocks this morning. My next guest is Schwab's Omar Aguilar, joining me to discuss this. We've just been through a litany of angst from Apple, AMD, and Tesla. This is a market that is disturbed about doing business in China and with China. Is it a healthy wake-up call at the moment that this is what you should fear in the tech market rather than incrementally higher yields?
Well, good morning. It's clearly the macro environment, tends to have a big role in the way that, markets behave. We have been, consistently focused on two things. What is the macro environment that allows these companies to perform and generate earnings? A lot of the companies that you mentioned, have been incredibly successful in generating significant amount of cash flow. But at some point, as you actually get to certain levels of market cap and certain levels of earnings, you basically end up having a road that is less linear than it used to be. I think a lot of the headwinds that they see from their business overseas, and particularly because of the disparity between the U.S. economy and the rest of the world, you can actually see how that eventually becomes a headwind for many of the companies that have business internationally. I think the situation in China in particular, where the economy, has a significant amount of impact on a lot of the technology companies that we have in the U.S., anything that happens macroeconomically in the Chinese economy tends to have a significant event of potential earnings for these companies.
And of course, today we've heard this reaffirmation from the National Convention in China that they're going to stick with the 5% target. Omar, I'm drawn to your descriptor there about the road ahead being less linear. And one of those obstacles on the less linear pathway is, of course, savings. And you make this point very clearly. Excess savings have fallen from just over $300 billion. To just over $300 billion, and that's down from $2 trillion in the summer of 2021. So you talk about this level of exhaustion in the 2 months ahead without wage growth, and this will slow down the economy in the second half of the year. Now, I've heard various people talk about this, the running out of COVID savings. What I want to get a sense from you is this going to be a slope of a slowdown, or are we going to face some kind of a cliff-like moment for the consumer?
Yeah, well, it is an interesting, dynamic because the consumer is also not just one big block, and it's sort of you can break the consumer landscape into 80% of the earners that tend to have a significant amount of really strong balance sheets that continue to have solid savings and continue to have significant amount of well-balanced consumption patterns to their savings, and that's critical because for them the amount of debt, the amount of consumption doesn't really affect their personal lives. On the other hand, we have 20% of the lower end of the consumers that have seen the significant impact of higher interest rates and the disparity between their consumption patterns and their wage growth, because their consumption has gone higher than the levels of earnings that they're getting, and that's where you're starting to see this stress. That's when you see a little bit more of the delays in credit card payments. That's when you're starting to see potential issues in car payments or potential delinquencies on some of their mortgage payments. So the good news for the U.S. economy, however, is that 80% of the consumers that are well balanced, they tend to have mortgages that are funded at a very low rates and they're locked in. And that's one of the reasons also why the housing market has been fairly stable, because there hasn't really been that much turnover, and the wealth effect for that part of the consumer is still, pretty robust.
I just wonder, when I look at the length of gains and runs higher that we've had, 16 of the last 18 weeks we've seen these markets, U.S. equity markets, run higher. We haven't seen that since 1971. Is it too late to go for breadth? You advocate in this soft landing scenario that you want to go for small caps, value stocks, etc., real estate. It's never going to be too late. You either participate in this market with a medium to longer term view, but I just wonder, it is so breathlessly high at the moment. Are you waiting before you deploy? Are you incrementally joining in those sectors?
Yeah, we always advocate always look at the long-term horizon and think about, what would be, your long-term strategy, and not necessarily try to find that timing where you can actually get in or get out. In fact, we try to always advocate our clients to just try to find pockets of volatility where they can use to rebalance their strategies and get them closer to their long-term objectives. Now, one of the points that you made, which is clear, is that we have seen a significant amount of rally since the low in October of last year, and it's been roughly 25 to 26% of market rally since then. Now, if you recall, the majority of the gains in last year in 2023, and also the majority of the gains this year, have been heavily concentrated in a lot of those top 10 names in each one of these market indices. So in many cases, what that does is it opens the opportunity for other companies that actually catch up and contribute more. And that breadth of potential contribution is something that we all expecting to at some point change. What is important right now is that, outside of the headlines of those indices that are heavily driven by, a few names, it is to actually find the opportunities when valuations still look attractive and then can potentially bring you opportunities for investing.
Okay, Omar, thank you so much for being with me this morning. Omar Aguilar, my guest on the markets. Coming up, Apple takes a hit, quite literally, in China.
Huawei is coming back, and Apple is probably going to lose significant share in China.
The Chinese consumers' impact on Apple next on Bloomberg.
If you look at Apple, really it's a competition, it's mostly a competition issue. So Huawei is back in China. They were not able to do phones for quite a while because they couldn't access chips manufactured at TSMC anymore. Now they figured out a way to do chips domestically on mainland China. They are back, and Chinese consumers like to buy Huawei phones.
New data revealing that iPhone sales have fallen by 24% in the first 6 weeks of the year. It's a similar story for another market, darling, Tesla. That's what we've been saying. China vehicle shipments plunging to the lowest level in over a year. Team coverage, deeper dive. Ed Ludlow and Craig Trudell join me now. Ed, if we've already talked about the fines that have been levied against Apple and about the drop in sales inside China. Does this put more pressure on Cook to diversify the demand cycle into India and other emerging markets at lower price points away from China?
Well, it's an interesting argument because if you look at the data, overall China's handset market, smartphone markets sank. And those that did better, you could say, okay, well, Huawei had an enormous jump in market share. It is more competitively priced than an iPhone handset. But some of the more budget names also had very modest growth or saw a sales decline. Tim Cook and Apple have always talked about India as the kind of sleeping giant, growing middle class. I remember 10 years ago being in London with you. We would talk about this idea of a growing middle class in India being a sleeping giant. 10 years on, it hasn't really come to fruition, but you see Apple investing in physical stores in India, developing its online marketplace. The story with Apple is kind of idiosyncratic in the sense that they're facing three threats, right? The domestic pressure from those handset makers, a difficult economic environment in China, but also the downward pressure on the stock right now very much relating to a lack of story in AI. That really seems to be the anxiety of the street.
Well, let's see whether they manage to turn that around. I mean, there is more pressure on Cook than there has ever been. Craig, good morning. Good to see you. So here we are with Tesla. We know the incremental lashings that Tesla has had. Nancy Tengler was with the Bloomberg Brief team this morning, myself and Danny, and she said, we are misunderstanding what the depth of value is within Tesla, and that is, it is about the batteries, it's about the plants, and that must be remembered for the longer term valuation narrative. She bought it at 104, she sold it over 200, and she's tipping her toes back into this market at these prices on the dips. Can you help me understand why Tesla, we need to perhaps look a little bit deeper than the headline incentives that were being offered to buy one?
Well, I think Isabel hit it well before the break, talking about the idea that, we shouldn't overread into any 1 month's results in China, especially the month of February, the fact that you do have the Lunar New Year having an effect on the month. That being said, this was a pretty bleak result, and I do think that there is a sort of, overarching theme that we've been seeing for weeks and months of EV slowdown that's given people real pause, some sort of unintended consequences of the effect of really slashing prices at Tesla and the effect that that's had on resale values. I think much as there's a lot to be said for the promise of Tesla, whether you want to look at it as an AI company, the fact that it brings a lot to the table outside of cars potentially in terms of battery player and energy storage, and a lot of buzz around the Megapack product, self-driving development that Musk has talked a lot about it being the sort of long-term driver for Tesla. I think the market was much more willing to entertain those things in a zero interest rate environment because Musk himself will like to talk about the idea that we make the impossible merely late. That he's been able to accomplish an awful lot with this company, but it tends to take him more time than he says he needs. I think the fact that Tesla has had so much of an issue with delivering on a lot of his promises leads to this sort of bang on the head when you do see some operational issues like we've seen in China and like we've seen just in the last few weeks in terms of disruption to their production even here in Europe, in Germany, which we're seeing again today.
Or is it that, as we mere mortals lack the imagination to comprehend flying taxis on Madison Avenue? Get the shopping done. Ed, thank you very much. I'll leave you with that thought on the West Coast. Craig Trudell in London. A little bit of breaking economic news coming across the Bloomberg terminal. Abigail Doolittle joins me with that. Abby, what have we got?
Indeed, we do have some of the final PMI, U.S. PMI data for the month of February coming in better than expected. For the S&P Global U.S. Services PMI, the actual was 52.3 versus the survey of 51.3, a little bit better than the prior. And for the composite, 52.5, also coming in better. This, of course, is in expansionary territory. Below 50 would be contraction. And we have the ISM services coming up today at 10 a.m. The estimate there is for 53, maybe setting up for those larger companies a little bit of strength there as well. Relative to sectors, Manus, we are looking at a 0.5% decline for the S&P 500, and it's that heavy tech weight, consumer discretionary and services indexes. Those are really weighing today on the S&P 500.
They are indeed, and tech is dragging us all into the bottom of this market. Coming up, market moving events for your day. We'll set up your trading diary. The week ahead looks like this. Fed Chair of Supervision, Michael Barr, speaks this afternoon. Plus, all eyes on the polls, Super Tuesday. And then it's Chair Powell testifying on Capitol Hill on Wednesday and Thursday. Thursday night, President Biden will deliver the State of the Union address. And Friday, you got it, it is the jobs report. That was countdown to the open. Tech is under pressure. Apple is down 23% this year. And Tesla also under pressure, dragging these markets lower.
20 minutes into the U.S. trading day on this Tuesday, March 5th. Here are the top stories we're following. China worries rattle big tech companies from Apple to AMD. The country is front and center for global investors this morning after setting a 5% growth target for the year. Worth the hype. Our markets guest this morning says that AI is still the hottest thing in town, and for good reason. We're going to discuss what that means for NVIDIA and everyone else. And an offer you can't ignore. Archouse CEO Gabriel Kahane joins to talk about his group's boosted bid for Macy's, as well as his thoughts on the company's plan to close 150 stores. All that and more coming up. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. And it's a down day for market, at least if you're looking at equities right now, because the S&P 500 off by about 0.5%, which doesn't seem too bad. But then you take a look at big tech. Of course, the NASDAQ 100 currently down by over 1%. But there is some green to be found, and no surprise, it's in the cryptocurrency space. You take a look at Bitcoin right now, continuing to surge higher and higher, up about 2% at the moment. Of course, we are on watch for that all-time high. Maybe today's the day. But we do have some breaking ISM data, so let's head right over now to Bloomberg's Michael McKee.
Well, this is not particularly good news for those looking for a growth scenario in the U.S. The ISM Services Index falls more than anticipated. It's still positive, but at 52.6 after 53.4, the consensus was for 53. But what's really interesting is the sub-indexes are almost all better. In this case, new orders are up to 56.1 from 55. Production is up to 57.2 from 55.8. Employment, one of the few that goes down, 48 from 50.5. So that's something to keep in mind for Friday, and it may have an impact on the market's forecast for what we get on Friday. And prices paid, 58.6, down from 64. That also good news in the sense of it tells the Fed that maybe inflation is not going to be a major issue. Yesterday, we had Raphael Bostic talking about companies being sort of enthusiastic about what's going on in the U.S. economy. And one of the things he pointed out, inventories were lower, and that's what we're seeing here. Inventories 47.4 from 49.1. It suggests that maybe companies are going to have to rebuild stocks, and that could boost the economy going forward. So a lot of cross currents in this number. Katie will also mention that factory orders come in down 3.6% after a negative 0.3 in the month of December. Factory orders ex-transportation down 0.8%. So this is still the hangover from Boeing not getting really any orders in January. Capital goods orders, non-defense ex-air flat. That's better than we had seen before, a slight decline. So businesses at least not pulling back.
And before we get to Friday, of course, and those jobs numbers, we have to get through Powell's testimony in front of Congress. I believe that kicks off tomorrow. Just quickly, what are we expecting to hear from the Fed chair?
Well, Wall Street and Washington are going to want to know when the Fed's going to cut rates and by how much, because it will affect both what you can earn and whether you get elected. But the Fed chair is probably not going to talk about that too much. He'll probably reiterate that the Fed has got more work to do on inflation. They're going to be watching the data, and that their decision will have nothing to do with politics. But plenty of other political topics could come up, including bank regulation, the Fed's balance sheet on which they lose money, and other things like that. So it could be an interesting hearing, but nobody will get what they really want, which is a date certain for a rate cut.
All right, Bloomberg's Mike McKee, thank you so much. I know that you'll be paying close attention, as well as, of course, markets as well. But let's get now to the market implications now with Shana Sissel. She is founder and CEO of Banyan Capital Management. And Shana, let's start with the broader macroeconomic environment and how that's informing risk assets right now. You can see that the S&P 500, it's still down on the day, but it is recouping some of those losses. What do you make of the setup right now as we still hover near these all-time highs?
Well, we've had some very strong economic data, notwithstanding what we just heard. And that has led people to believe that even with higher rates, we can still have strong economic growth. Now, that said, the data that just came out, I think, is favorable for the folks who want the Fed to cut rates. anything that can show potential softening in the economy would be a good thing because we've had very strong GDP growth. The job market remains tight. Inflation remains elevated, and so the Fed is going to be looking at data points that indicate that the economy is starting to soften to justify a rate cut, which I think is exactly what they want to do. And up until now, there hadn't been a lot that they could point to say that. So overall, I think the markets are really looking at the overall trend. There was this feeling that higher for longer was bad, but higher for longer is not so bad if the economic growth is 3 to 4%.
Well, Shana, I'm glad to have you with me because let's talk about the ultimate risk asset, and that is Bitcoin, of course. The red headline crossing the terminal right now that Bitcoin surging to its first record high since November 2021. It has been quite a journey to get us there, to say the least. And I mean, talk to me about that, because you think about the difference between November 2021 when Fed funds were at zero effectively and where we are now, you know, well above 5%. What do you make of those types of moves in this market?
Well, obviously risk is on. People want to be in risk assets, and so Bitcoin is the ultimate risk asset. I think the launch of the 11 Bitcoin spot ETFs has a lot to do with driving market demand. You know, if you look at the actual available liquidity in Bitcoin, like something like 85 to 90% of Bitcoin is not liquid. So that 10% that those spot ETFs are playing with, and the flows into those funds are tremendous. You know, I believe there's 4 that are over $1 billion, and the BlackRock one is at like 9. So, you know, if you think about it, the flows into these products are very strong. So I think those two things are part of the story. And then you have the halving that's coming up in April, which will also push the price up. So a lot of tailwinds for Bitcoin right now, not the least of which is that people are more likely to take a chance on risk assets.
All right, really appreciate that. And of course, you mentioned those spot Bitcoin ETFs. Those launched in mid-January, like you said, upwards of 10 or so that actually launched as new ETFs. As an investor, how do you do due diligence on those products, given that they all hold the same thing? What does that process look like from your shoes?
For me, I look at who the issuer is. So obviously the big winners, Fidelity and BlackRock, they have overall trust. They have a lot of experience just running ETFs. For me, I prefer Bitwise's BitB because this is a firm that has been dedicated to the crypto space for years now. I first met Matt Hogan in 2017 when they were just getting up and running, and he has really been able to help with the advisor market. They're very good with education. They're very dedicated to the space. So I'm encouraged that people see that. For me, it's all about the issuer. I want to be with an issuer that knows what they're doing and that is dedicated to the space. So I tend to prefer something like BitB versus iBit or Fidelity's product, which have obviously been the two biggest winners because just the large scale of the firms behind them. But for me, the due diligence becomes about the issuer and not necessarily the underlying.
Fair point there. And you take a look at BitB. It is one of those ETFs that has over $1 billion in assets already. Total market cap looks like $1.8 billion at this moment for BitB. But talk to me about the rest of the risk asset universe, because obviously you have Bitcoin ripping to record highs. But then you take a look at some of these riskier parts of the equity market. For example, you have small caps, and it feels like even though they had a great end to 2023, they just haven't been able to keep up that momentum in 2024. Just quickly, what are your thoughts on that space?
Well, here's an interesting stat from Strategas that kind of blew my mind. 75% of the return of the Russell 2000 is from Supermicrocomputer, which is now going to be added to the S&P 500. So this should be interesting to see how that impacts small caps. 75% of the returns of the Russell 2000 are attributed entirely to Supermicrocomputer. So it's not necessarily a great thing for small caps, but if you believe that we're going to have some softening in the U.S. economy, you know, and you think about what happens as we get into later stages of the economic cycle and then start a new economic cycle and you get back in early stages, that's actually typically favorable for small caps. That said, small caps have not behaved at all like they would historically based on, things like new bull markets and just watching market trends. But I think it's because they're not as exposed to the bigger trends other than supermicrocomputer and AI and cloud computing and things of that nature. There's not a lot in that space that has exposure there, and I think that is one of the greatest headwinds in the space.
All right, Shana, stick with us. We haven't even talked about AI yet, but you're just going to sit tight for a couple minutes because we're going to take a quick look at what's moving underneath the markets now with Bloomberg's Emily Grafeo sitting to my left here. Tell me about Target.
So they had a pretty good quarter. Their fourth quarter adjusted EPS beat estimates, coming in at $2.98 versus estimates of $2.40. Their comparable sales declined 4.4%, which slightly beat estimates, but it did fall for the third consecutive quarter. Like a lot of retailers, Target has really struggled here with their profit as inflation is higher. Consumers are spending less on items when they go to these retailers. So that's really been an area of focus for Target. But they are seeing the biggest jump since November in the stock price. And another area of focus for a lot of the retailers is the inventory. So are they able to kind of clear the inventory so they don't have to see as much of a loss when they can't sell all of it because people don't want to pay for it? And Target said this quarter they reduced inventory by about 12%, which was better than expected.
And you can see that being rewarded in the shares, up over 11%. It's a different story for Stitch Fix.
It is. This is a much smaller company, kind of like a small cap like Shauna was talking about, but this is down as much as 20%. Biggest intraday decline since June 2022. And Katie, it's not looking good for this retail company. This is a company where consumers can get a personalized stylist. And so they go online, they take a style quiz, and then Stitch Fix will send you a box with like 5 or 6 different clothing items that are tailored to you, and then you can choose whether you want to buy it or not. But they reported a heavier than expected loss per share. Their full year forecast also missed estimates. The street is pretty bearish on this stock. Piper Sandler has an underweight, and they said that this decline in revenue underscores the difficulties externally and within the business. A lot of those clothing rental companies were really big during the pandemic, and now they're falling. This one's down over 80% since its IPO a couple years ago.
Yeah, definitely. The world has changed for a lot of these companies. And just quickly, tell me about SoFi, because that's another stock really feeling pressure today.
Yeah, plunging the most since January. This is an online personal finance company. They announced a proposed convertible senior note offering. So a bond offering due in 2029. According to a Bloomberg article, which cites people familiar with the situation, they're offering a 1% to 1.5% coupon for this $750 million convertible bond. It doesn't seem like the street is liking it, though, because like you said, that stock is plunging today.
Yeah, big time. Emily, really appreciate that. Of course, is Bloomberg's Emily Grafeo. Thank you so much. Now, coming up, China setting an aggressive GDP goal of 5%. Analysts questioning just how the country is going to get there. Details next. This is Bloomberg. Well, China set a GDP goal of 5% at the 2024 National People's Conference earlier, and that target is putting pressure now on the nation's top leaders to release more stimulus. Joining us with more now is Tom Orlik of Bloomberg Economics. So 5%, that's the goal. How exactly are they going to get there?
So at first sight, Katie, 5% doesn't look like a particularly stretching target. In 2023, China grew 5.2%. So why can't they do another 5% this year? Well, remember, growth last year was flattered by a very low base from COVID lockdowns in 2022, and that boosted the growth number. This year, getting to 5% is going to be much more challenging. Still, Li Qiang said that's the aspiration. The question the markets have is, well, where's the stimulus going to come from to get us there? The growth target was in his speech, but there wasn't much details on what was going to back it up in terms of more fiscal spending, more monetary stimulus, or more support for the ailing real estate sector.
And talk to us about this growth target in the context of geopolitical tensions, because of course when it comes to the U.S.-China relationship, it feels like a lot of that is playing out in the semiconductor industry. And one of the most read stories on the Bloomberg this morning is about AMD hitting a U.S. roadblock and selling its AI chip that's tailored for China. How are you thinking about that over at Bloomberg Economics?
So it's really interesting, Katie. I think Wall Street is looking at Premier Li Qiang's work report and saying, well, where's the details? And it's certainly true, the details on stimulus are not there. But if you think about the priorities for Xi Jinping and China's leadership, boosting defense capacity, boosting spending on science and technology to try and ensure reliance or independence from US tech, that's actually where the detail is in this National People's Congress. And that speaks to a shift in priorities in Beijing from a dash for growth to the crucial importance in Xi's mind of securing the nation in a more hostile world. Now, of course, the mood on China has also changed here in the United States. One of the key initiatives from the Biden administration has been a move to block semiconductor sales to China. AMD thought they'd produced an AI chip which was kind of regulation consistent and which they could sell into the Chinese market. They've just heard from the US government that's not actually going to be the case, and they will need regulatory approvals.
All right, Tom, really appreciate your insight there. That, of course, is Tom Orlik of Bloomberg Economics. And let's welcome back now Shana Sissel. She is founder and CEO of Banner Unit Capital Management. And Shana, we were just talking about AMD there, and I want to keep the conversation going on the chip sector because, of course, NVIDIA is just stealing headlines, stealing eyeballs, really carrying this market forward. Of course, we did get NVIDIA earnings a couple of weeks ago. How are you thinking about this just mega cap company now and the fact that so much of the market's gains and euphoria really seem to depend on it?
Well, full disclosure, I own the stock, so I'm happy about this. I think that NVIDIA is uniquely positioned. They don't have a lot of competition. There's too much demand for their chips. They are not able to keep up with the demand for their chips. They're in a lot of really core markets. You know, we talk about NVIDIA with AI a ton, but data centers and autonomous vehicles are a huge part, not to mention the foundational business that kind of started the company, which is the GPU chips. So they have a lot of opportunity here. There's a lot of demand. They don't have a lot of competition. And so all those reasons are really positive. I heard someone say recently, like, this is 1999. This is the tech bubble all over again. And I want to really point out that that is not the case. This is a cash-rich company that is growing revenues at triple digits. And that is very different from what we saw in 99, where we had, you know, companies that were going up and up and up with no earnings, no cash flow, no real business. This is a real business making real money that's cash flow rich. And for those reasons, I think that it's going to continue to benefit from the tailwind that comes with this AI revolution, which we're really only in the second inning of, and they are such an important component of that.
And it's also a mature business as well. Of course, NVIDIA has been around for decades. It's not like it's a totally new kid on the block. But to your point that it doesn't have a lot of true competition, let's bring it back to AMD. You know, AMD is trying to develop the chip that will rival NVIDIA's lineup in some senses. How long will that head start truly last for NVIDIA?
I think it lasts pretty long, because as people are developing new technologies related to AI, they're going to be using NVIDIA as a default chip. And once that technology becomes dependent on their chips, it's really hard for somebody new to break in unless their chip is substantially better. And I don't know much about what AMD is working on and how much better it is than the NVIDIA chips, but also NVIDIA has a great market share of all different types of semiconductor chips for all different areas of the market. So again, I think that it's a well-rounded business. It has, as you point out, been around for a long time. I have been following it since 2000 and watched it get included in the S&P 500. I think it was like 2002. So it's a long tailwind here, and I think that there will be people who obviously want to come into the space. Obviously, there's demand. NVIDIA can't keep up with demand, so there's going to be an opportunity for somebody who can kind of fill in the gaps. So NVIDIA needs to really focus on being able to increase their production and make sure that they can meet demand, so somebody like AMD can't sneak in there to take advantage of that.
Absolutely. There's a lot of rivals that would love to just chip away at that market share. But let's shift gears a little bit here, because in addition to the chips, NVIDIA, et cetera, I know you're also favorable on some of these energy names as well. Diamondback Energy in particular. What's the opportunity set in that name?
I think Diamondback is interesting because it's one of the few independent producers that actually can make good money and have strong margins on oil at lower numbers. So their break even is like $50 a barrel, which is different than some of the larger producers, which need higher energy, higher oil prices in order to really have good profits, good revenues, good margins. And they're very much executing well. Financials are very strong. Management is strong. And the company has the opportunity to either be an acquirer or be acquired. And these things give it a lot of flexibility. It's one of the reasons why I really like the stock. It's also trading, relatively at a reasonable multiple. And so, these are things I look for. There's not a lot in the energy sector I love, but that is a stock that I do like that actually has done quite well. And it has a great ticker.
Yeah, the ticker there, of course, is FANG. Shana, really enjoyed this conversation. Come back soon. That is Shana Sissel. She is founder and CEO of Van Ryan Capital Management. Now, still ahead, we're going to take a look at the companies making the most social buzz today. That is Social Climbers. Up next, this is Bloomberg.
It's a huge week in politics. Today, It's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, Thursday, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lines, and Bloomberg's top political analysts will bring you live global coverage of both events, starting at 9 p.m. Eastern. Bloomberg. Context changes everything.
All right, time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, the software development platform GitLab out with a weaker than anticipated forecast. Bloomberg Intelligence writes that the outlook may be reflecting uncertain demand from small to medium-sized businesses. Next up, you have Tesla shares on the skid after news that its China shipments plunged to the lowest levels in over a year. Figures point to a slowing EV market in the country. And finally, we have some not so good news for Novo Nordisk, the pharma giant's famed drug Ozempic, not as effective in cutting kidney disease risk as analysts had hoped. And of course, you can follow all the company buzz on TRE and Go on your Bloomberg terminal. Now coming up, Ark House and Brigade Capital increased their offer to buy Macy's by 14%. We speak to Gabriel Kahana, Ark House CEO, managing partner, and co-founder, next. This is Bloomberg. We now welcome in our TV and radio audiences. Ark House and Brigade Capital Management raising their offer to buy Macy's by 14%. Now, Macy's has responded to the offer saying, quote, the Macy's board will carefully review and evaluate the latest proposal consistent with the board's fiduciary duties and in consultation with its financial and legal advisors. Macy's shareholders do not need to take any action at this time. Joining us now, I'm thrilled to say, is one of the minds behind the offer. Sitting next to me is Gabriel Kahana, Ark House CEO, managing partner, and co-founder. Gabriel, great to have you in person. Let's talk about this raised offer, the bid going from $21 a share to $24 a share. Are you prepared to raise it again if Macy's rejects this?
We certainly hope they don't reject it. And you know, they said that they will carefully review this offer in that statement you just read. We sincerely hope that they really do carefully review it in good faith, as they should have almost, I guess more than 3 months ago at this point, our initial offer. And we also think that Macy's shareholders, in that statement, Macy's executives are telling shareholders they don't need to do anything right now. Our view is that Macy's shareholders own this company, and they should do something, which is reach out to their directors, reach out to their executives, and urge them to engage sincerely and in good faith with our credible buyer group.
And I want to bring you a line from the press release that you put out in relation to this offer. I thought this line was interesting. We may remain frustrated by the delay tactics adopted by Macy's board of directors and its continued refusal to engage with our credible buyer group. Have communications changed or opened up since this latest raised offer?
It's hard to say. There's certainly been dialogue, and dialogue continues. But what we're asking for is that dialogue progress from communications and dialogue to action and to a substantive conversation and engagement wherein we can contract and give shareholders a really significant premium in cash today.
And you're probably aware, but there's a train of thought out there that Ark House and your partners in this bid are chiefly invested in Macy's real estate portfolio. I know you've said publicly that's not the case, but what do you make of Macy's plans to close 150 stores?
I think it's a shame. We are not focused on store closures, and in fact hope that we get to close on the company before they close any stores. Our view is that the real estate is incredibly valuable, in large part because of its tenant, Macy's.
And I mean, hypothetically, should they actually go ahead and offload those 150 stores, close those 150 stores before you close on any bid, would that lessen the appeal of Macy's for you?
It's hard to say without the diligence that we're requesting. We're sort of taking an outside view in, so I can't speak to that.
And let's say, hypothetically, that you do acquire Macy's before they were to shut those stores. In your plans that you've been thinking about for Macy's, is it possible that you could actually close more than 150 stores, or what would you actually do with the real estate?
That would be very surprising. For us, it's really much more of a capital markets rejiggering and a capitalizing on the awesome asset base that they have, as opposed to let's close stores and redevelop them into something else. Certainly, I'm sure it's the case that there is redevelopment opportunities in this portfolio, probably largely not through demolition and redevelopment, but in out parcels and malls and other interesting development opportunities that I'm sure will be availed to us when we get that diligence. But right now we're not underwriting that at all. Our base case assumption is that all Macy's malls stay open, all Macy's locations stay open, and that we enhance the creditworthiness of the tenant inside the store.
And I promise we're going to talk about something other than real estate in just a couple minutes, but I do have another question because your bid...
I like real estate, so it's all good.
We all do. So this bid values Macy's at $8.7 billion, the entire company, and there's an interesting analysis out from Bloomberg Intelligence that estimates that the real estate alone is worth upwards of $8 billion. So from that perspective, $24 a share, it could be seen still as a lowball offer. Are you worried at other bidders coming in here to this process?
I am. I'm really hopeful and pretty optimistic that we've put together the right buyer group to be incredibly competitive in any process that starts, and I have a high degree of confidence that we'll win.
A high degree of confidence there. Let's talk about if you win. Of course, you would take Macy's private. What can you accomplish by taking Macy's private versus keeping it as a public company?
A lot. a lot. As a public company, it's hard to blame existing management for focusing on the quarter, because that's how they're judged.
Mhm.
They're judged day to day, their share price changes, their cost of capital changes instantaneously. As a private company, you can focus on long-term prosperity, growth, and a stabilization of this business that's otherwise seemingly headed in a pretty scary direction.
And what info do you still need from Macy's when it comes to your due diligence that you're doing on this company, that you're doing in potentially raising another bid if they do reject this one? What do you still need from Macy's?
Really confirmatory diligence. It's not complicated, but it's a lot of work.
Mm-hmm. And you've also, of course, as part of this, nominated 9 people to Macy's board. How confident are you that you actually have the votes there to do that?
So, you know, the 9 director nomination is really a function of the board size. They are 14 directors, so to ensure that we are speaking to shareholders directly, and really to ensure that shareholders can exercise their desires, their wants, and see to an effectuated change, we need to nominate 9. So, yeah.
And how is the communication with shareholders happening? Is that you reaching out proactively to shareholders? Are you seeing inbound requests? What's the mix there?
I would say it's a combination. We've not formally submitted any proxy materials, and we're not soliciting votes at this time, but we have received inbounds from shareholders, you know, on an unsolicited basis, and are very happy to speak with anyone. We are a significant shareholder in this company and have very strong views about it.
And let's talk a little bit more about financing here, because that has been one of the questions. Of course, how would you pay for this? And you have also said that you've identified large global institutional financing sources that represent 100% of the capital required to buy the shares in Macy's that we do not already own. Can you give us some detail about who those large global institutional financing sources could be?
Yeah, so they are, like you said, large global money center banks. And the company shouldn't be surprised that there's so much interest in participating in this capitalization. They have a really great asset base. And, you know, hearing some of their responses that it's a tough capital markets environment, it's a tough financing environment, all of that's true. And notwithstanding that, there is robust interest in participating in this privatization.
All right, Gabriel, it's going to be really interesting to watch this one play out. Hope to continue this conversation soon. That, of course, is Gabriel Kahana, the CEO of ArcHouse. And now let's get a quick check on these equity markets. Of course, we're over an hour into the U.S. trading day. We're going to do that with Bloomberg's Abigail Doolittle.
Well, we are looking at some bearish action for markets today, Katie, but before we take a look at what's happening for markets more broadly, let's start out with a bright spot. It's not exactly Macy's, but it is Target. Shares are surging on the day, up more than 10%, heading to the best day of the year. And this, of course, after they beat adjusted earnings by 27%, putting up nearly $3 in adjusted earnings on better gross margins, as inventories have gotten a little bit under control. So investors really liking that for the shares of Target. As for the bearish market outlook, let's take a look at the S&P 500, down 0.9%. Overall, we are looking at session lows. You can see the NASDAQ 100 underperforming, down for a second day in a row, down 1.8%, really being dragged on by Apple and Tesla, and of course weakness for both of these companies coming out of news from China. Apple, the first 6 weeks for the iPhone of this year, down 24% on a year-over-year basis, as Apple's popularity for the iPhone slides into 4th place for smartphones in China. Tesla down 5% on the news yesterday that their activity for February, the shipments out of the China factory, the lowest in more than a year. Turning this into Bitcoin, though, this is a bright spot. So we have negative spots and bright spots. And, of course, Bitcoin today hitting an all-time high. You can see this 5-year chart. Not a picture of stability, a parabolic uptrend. So like those last two then record highs, we may see somewhat of a reversal. But for the crypto gold bugs, certainly they are probably enjoying this rally, as are the physical gold bugs. Gold spot hitting an all-time high on the day, up 0.8%. When you put that together with the 10-year yield down 7 basis points on the day, Katie, and then stocks lower, it really creates a bit of a risk-off picture as investors are looking for havens and getting out of stocks.
Yeah, there's definitely something poetic about the fact that you had gold and Bitcoin hit their all-time highs on the same day. Bloomberg's Abigail Doolittle, thank you so much. Now coming up, we're going to hear from Judd Kramer, Harvard lecturer, about the role of borrowing costs in inflation. That conversation coming up next. This is Bloomberg. All right, well, it's time now for Wall Street Week, and today we're looking at how the high cost of borrowing is impacting how Americans feel about the economy. Bloomberg's David Westin sat down with Judd Kramer, a Harvard lecturer who penned an article with Larry Summers about the trends. David asked him why consumers aren't buying the story of a strong economy despite some of the data.
Traditionally, economists have been able to look at GDP growth, inflation, and unemployment, and from that really get a good measure of where consumers will have been. But this time around, something seems to have broken. And so that's what led us to really try to dig into the inflation measures and see what might have been different now versus how we were measuring things in the 1930s.